Hello and welcome to the Think Realty webinar series. Today we're going to be talking on the topic with rising interest rates, is real estate investing still bigger in Texas? We are very excited to have our panelists today. Alex Buriak from Jet Lending, he's going to be our moderator. Shanoa Grove from Texas REIAs, Rob Barney from DHLC of Investments, and Kristen Gertz from Capricorn Mortgage Investments. Before we get started, just a couple of reminders. We have the Think Realty Conference in Tampa coming up on July 21st and 22nd with speakers and sessions on single family, multifamily, private lending, you name it, it's there. If you want the education and information and networking, it's going to be a great event. Go to thinkrealty.com and get your ticket today. Just so you know, the recording will be available after the session. We'll send that out to everybody that is signed up. And then finally, if you have any questions, don't hesitate to go ahead and put that in the chat window below during the session, because we'll include those throughout the hour. So definitely include those in there and be able to have a conversation about whatever question you have. So with that, we'll turn that over to Alex Buriak. Alex, welcome.
Thank you very much, Rodney. And now we're definitely going to have a great talk with a lot of expert ideas that are going to come your way today, and hopefully you guys take something from it. So let's really just jump right into it. Like Rodney said, this is real estate, rising interest rate, and real estate investing. Is it still bigger in Texas? I think so. But what I'm going to do is start kicking it off to everybody with just an initial question. You guys all invest in Texas today, whether it's going to be investment properties or buying notes or anything that's going to get you into that asset class. Give us a brief summary of one, just in case anybody doesn't know who you are, what do you do, and how are you still investing today? Rob, let's start off with you.
Hi, I'm Rob Barney with DHLC Investments. We've been doing this for about 21 years now. We're a private lender here in the Dallas area, but we lend across Texas. I've been investing in property myself, as well as funding people that are investing in properties since 2001. And I'm still very bullish on this market. I'm still lending at a good clip. We're still looking at opportunities ourselves. We've been fortunate enough to be warehousing some properties personally that I'm beginning to put on the market, but things are just as good now as candidly as they were 20 years ago.
Yeah, I couldn't agree more. Shanoa, what about yourself? Who are you to everybody, and what do you think?
Hi guys, Shanoa Grove here from Texas REIAs. We have Real Estate Investor Association meetings throughout Texas in Austin, Houston, Dallas, and San Antonio. We meet every Tuesday night. We go over a market update and we talk about issues exactly like this in terms of how market dynamics are affecting us in terms of being a real estate investor, what opportunities they create. And, you know, for me, and I think probably for all of us, you got a bunch of, 20-year investors on here. And I think, when before we started the actual recording, we all kind of said, well, I remember when I first started investing and interest rates were, 7-8%, this is still amazing. So I will tell you that everyone you're listening to today has that perspective, has that sort of long-term outlook, and still thinks that whether the interest rates are 5%, 6%, 7%, they're still pretty good. And I couldn't agree more. And one of the things that continues to lift this market is not so much the worry about interest rates, but just the fact that, yes, it is bigger in Texas. People are moving here like crazy. Now, if you guys told me interest rates are rising and people are not going to move here anymore and companies are not going to relocate here anymore and people are going to stop having babies and the entire economy is grinding to a halt, then my tune would be a little different. I'd be saying something completely different. But with interest rates, going up even, oh my gosh, a point or two, that doesn't really scare me because the opportunities are still out there. The deals are still out there. It's incumbent upon us as real estate investors, no matter what the interest rate is, to make your money on the buy, which means we all still have to buy it right. Where we get in trouble is where we don't buy it right and then get punched with something else that comes into the marketplace. So I'm super excited about the future of Texas specifically. And normally I don't forecast out past 1 year, but because of where we are in terms of housing permits, for example, in 2020, I think we did 160,000 new permits. In 2021, we did 170,000 permits. I think just the four of us on this call right now could probably find a home for all of those 10,000 homes, which is not much considering that we probably have, I don't know what the stat is, but probably about 1,000 people moving to Texas every single day. So when our housing inventory starts to grow beyond about a month of inventory, which is what it is right now, throughout and different in some of the different markets. Some markets have as much as a month and a half. But once it starts to creep up to 4, then again, my tune will change. But where we are right now, too many people moving here, which is good problems to have if you're a buy and hold investor, right? Too many corporations moving here, too many job openings here, and too many people still having babies here. So I think there's a lot of opportunity for Texas on the road ahead.
Well, I couldn't agree more. All right, well, Kristen, tell us about who you are if they don't know. What are you seeing in this market? Give a little bit, maybe brief summary of how you're seeing it. What are you doing to do?
I'm Kristen Gerst. I own Capricorn Mortgage Investments. We buy and sell owner finance mortgage notes specifically. We're in that secondary scratch and dent market. As far as what I'm seeing a lot of, because I buy in large pools, so I will buy 1 to 5 million at a time, and then I sell to hedge funds and REITs. And they have started tightening their buying criteria just because it's not because of loan to value. Loan to value is still phenomenal out there. But it's interest rates. And so, if I get a loan that comes in and it might be a 7% interest rate, I can tell you right now that investor is not going to like my offer on that note just because I'm having to buy at higher yields right now. Just because, the nature of, how, my end buyers, need to have like a larger spread. So, if they're looking for that 4 and 5% spread, yeah, they couldn't buy it, a 9 or 10% yield anymore. They're up there at an 11 or 12% yield. And so, yeah, that has adjusted. Do I think that, Texas is still a phenomenal place to invest? Yeah. I mean, stuff is, if you've got a great product, if you have flipped a great house, you're going to sell that thing in hours. I've been personally shopping for my own new house. And I've basically given up until the fall. I'm just going to wait because I'm just like, all right, this is too much of a beatdown going and competing against all of these buyers out there. So yeah, no, I still think it's a great place. There's tons of money to be made. There's tons of deals out there. There really are. And it seems like it's even ramping up and we're getting more now. But if you're in the, origination market for owner finance notes, I hope they're using an RMLO because it's so important. One, it's the law, but once you get past that, it's the law, and all these people who still don't want to use an RMLO, the RMLO will help you charge that interest rate, that the highest interest rate you can, and still keep it a qualified mortgage, because you never know what's going to happen. While I tell all of my investors, hey, keep as many notes as you possibly can. This is your wealth building. You never know when you're going to need to sell a note. And if you create a bad piece of paper because you decided not to use an RMLO, where you decided, well, they're putting down 25, 30%, and so I'm going to give them a 6 or 7% interest rate, you could be really sorry down the road.
I can't believe, that tricky little thing of following the law. It's always cumbersome.
Right.
And for those of you who don't know, I won't take too much time. I'm Alex Buriak. I'm the Senior Vice President at Jet Lending. We do short-term loans. We do long-term loans, anything investment in real estate in Texas and anywhere you can buy. So we're going to kind of kick off with, we had a little bit of a brief interview of who everybody was, what are they doing, a little bit about how they thought. So let's get into a good question. We're going to go in reverse this time. Kristen, what are some of the strategies today, especially because you're more into the note side of things, not to say that you don't have your own properties, but you have note side of things like that. For each of you, what are some of the ways that you guys are purchasing investments today that are offsetting some of the higher interest rates that you're seeing?
A lot of people out there know that I recently started an Airbnb property management company. I got into Airbnbs 5 years ago, primarily because I was getting killed in taxes, and my accountant said, you only have notes. You need to get some actual real property, just because of a tax, from a tax stance. But I find that Airbnbs are a great way to hedge about that. I actually just sold two, and I sold them basically because my private lender needed me to, and just sell them really quickly, as opposed to taking 4 to 6 weeks to refinance out. But I'm now, taking the cash from those sales, and, I'm going and searching for more short-term rental properties.
Awesome.
And it's a great way. People ask, do you see saturation? No, I don't see saturation yet.
No, great. I mean, there's a lot of people that they'll use the term like diversify. I don't really feel like, you're diversifying while you're in your same asset class. You're still in real estate. You're still kind of hedging different types of bets as you were, especially for the appreciation of things that are going throughout the markets. So I think that's great. I mean, Chanel, what do you yourself do? What do you teach people? But okay, there's high interest rates. What do we do? Should we stop buying? No. How do you think people should take a look at this on how they should kind of hedge that change?
Yeah, I mean, I think that many of the hard money lenders are still lending at the exact same rates, a year ago, even versus today. I think a lot of the private money lenders are still lending at the exact same rates a year ago versus today. I think, I know Jet has a ton of money sitting ready to loan at any and all times. I know my friends over at Quest IRA are still lending anywhere from 8% to 12%, right? And Quest has over $2 billion under management of people's old 401ks turned self-directed IRAs, and many of them use it in the note, field, lending to other investors. So, and I think that there are a lot of people who have gotten a little exhausted with the need for a defibrillator in the stock market. Apparently, stock market investing comes with the need to be recharged every now and again. And so they're moving their money out of the stock market and looking for other hard assets to invest in. I think there's a ton of people out there who would be happy to fund, any and all of your deals. Don't just think about it, just getting it from a regular, Chase, Wells Fargo, Bank of America. There's plenty of other resources for funding. And there's so many people all the time who want to get into real estate, and in many cases don't know a lot about it. And in some cases they'll say, yeah, no, I'll lend even at 6%, 8%. So that money is still out there, just like before, and again, as a real estate investor, we have to, we make our money on the buy. If we're not going to buy it right, then it won't matter if we get a 1 or 2% adjustment in the rate of funds that we get. It's the buy that's going to get us. And that's what we need to focus on. Of course, we're going to all run our numbers and make sure that each one of the properties makes sense. But, for me, I'm telling people, yeah, get property in Texas, anywhere and however you can. And I think we had mentioned a little earlier, is like, don't look at what it costs you, look at what it makes you. And, I see a lot of, it's so interesting right now. I think the bigger, for us as real estate investors, I think the bigger kind of punch that we are all working with is, this week, or is like maybe even today is the last day to get your property protest in, right? We're seeing more of a hike right? In terms of our cost of the property, more, it seems like in the property taxes than we are seeing in the interest rates, right? If you were to just kind of do those calculations. So I think that is probably the bigger punch that's hitting us right now as real estate investors. But again, you just have to do your numbers. You got to make, you make your money on the buy. And, we're in a market right now where I'm seeing a lot of real estate investors, will tell me like, well, I wouldn't have made money except for the market went like this, right? Because my expenses also went like this. Usually that's on the side of the reconstruction or the property taxes or the labor cost, right? But for the most part, seeing a 1% increase in interest rates, I'm not seeing that as being a high, as high of a, of pressure on real estate investors as I am, seeing, all of the, at least for the buy and hold properties or even the investments that take longer than a year, I have investors that are coming to me all the time saying, Chanel, what I'm going to do about all these, high property taxes, I think I'm going to sell. And it's like, well, you're crying, I can tell. And it's like, here's a tissue, but you're crying all the way to the bank. And I took a poll and nobody feels sorry for you, right? Because, yes, you might be paying higher property taxes, but you're paying higher property taxes on something that's building out your wealth and building out your income. You have to look beyond just what's right in front of you, just that interest rate piece, and look at the entire, time period that you're going to be holding that property.
Yeah, exactly. I mean, we're like, we did say something when we were all talking before the show started, but we're like, just look, when you guys are listening out there, make sure, think of things in profits, not costs. Okay. If things are still making you money, then it's worth the expense. So I couldn't agree more. Rob, what do you think? We're just kind of reiterate the question. What are some ways today that you are seeing, let's say you're seeing the interest rates and they're changing? How are you, is there anything that you're doing that's offsetting what you're seeing like in terms of rate?
Well, I'm going to reiterate the same thing that everybody else has said, because it's actually true. You don't make money in real estate when you sell, you make it when you buy. There's a gentleman by the name of Tom Henderson that first told that to me 21 years ago, and it's as true today as it was back then. The thing to realize is that there is so much capital in the market right now, in the real estate market and into the capital markets, that rates on our side are probably not going to be going up much, because there's so much capital to deploy that we've got to deploy it. And by raising our rates is going to slow down our ability to deploy it. So I don't see hard money lenders, private lenders really ratcheting up their rates for short-term loans. Now, you might see it a little bit on some of the buy and hold funds, but I don't see it happening as much on the short-term fix and flip. That being said, my hedge, if you will, is to be buying a few more rentals, because I'm looking at how I can go ahead and cover some of that increased cost by rentals. And obviously the rental market is so strong here that rental rates are increasing at a higher pace, at a faster pace than the interest rates are.
Sure.
One of the nice things about Texas is we have had an inordinate amount of equity growth happen within the last year. But I don't see that happening. I don't think we're going to be having a retraction in that. In 2007 and 6, when we had our big meltdown, we saw things slow, but that was because the capital markets weren't available to fund the acquisition of those properties. That's not our problem now. And I think the only thing that we will see as things begin to cool a little bit is the fact that people are not going to be overpaying on list prices that they have been over the last year. I think you'll probably see whatever list is going to be what people are going to pay. And I've seen it a little bit already on some of the assets that I've been liquidating. I think that the great thing about what we are doing is that this is a healthy market. We were discussing before the webinar started is that when we all got into this, rates were in the 7s, and a healthy market is anywhere from 5.5% to 7.5%. We're right in the sweet spot of it right now. There's still, as Shona said, there's less than 30 days demand, or excuse me, 30 days worth of inventory. A healthy inventory is anywhere from 3 to 6 months worth of inventory. We don't have that. We've got people moving into Texas much quicker than we have the ability to find them property. So as long as that keeps happening, as long as interest rates are a nice, healthy range, and as long as rental rates are nice and solid, you've got a great opportunity to invest. And from a hedge standpoint, going back to that, Alex's rentals, I think, are a great way to do that, because the rental rates are vastly outpacing interest rates.
No, I did. So and then a couple of key things, if you guys are paying attention, you should be taken away from that is rental rates are increasing. It's going to shift your expenditures because you're going to be able to rent the property for more. 2, the appreciation rate has severely increased. So that means you holding these properties are going to be worth more. The key to wealth of rental real estate, holding real estate, is actually the property appreciating. Cash flow should be like icing on the cake. The reason why you're probably not going to start seeing things like 2006, 7, and 8, because this is not, like has been said, not a financial amount of currency that could be deployed issue. This is a supply issue. This is a supply crash. So it's not that you can't deploy money like you saw in 2006, 7, and 8. It's the fact that there's nothing to buy. And because there's nothing to buy, you may not see that money foreclosures because of the equity that's already been increased in the property. These people, when they're in trouble, can just sell them. So there's a lot of things you can still do in this market, whatever the interest rate. But as long as all 3 of our speakers said today, you have to buy it right. So awesome. So
Alex, I'm sorry. I want to mention one last thing about just hedging, and just there are so many 0% interest rate credit cards out there right now. Like you can buy your house at, 5.5%. Oh my, right? And then you can get a Home Depot credit card for $60,000 balance for 0% interest, and then probably have that property fixed, flipped, and sold right before your even first payment is due. So even if you're paying higher interest rate on the house, if you are using, you have to be a little creative, right? There's a little bit of a dance there, but that's absolutely a way that you can kind of bring down your average cost of capital on your total project as another way to be able to do that as well.
Great. Well, I agree. So let's talk about each one of you said the same thing. So let's expound on it. In about early 2000s, the interest rates were in the 7s. Okay. The rates today, prime is at 4. A month ago is 3.5. A year ago is at 3.25. The Fed is going to increase it at least 5 more times in the next 18 months. They said at 1/4 point, but as we know, they just do what they want. So we may be different. As the rates start shifting, especially in the long-term note side, how are you guys seeing the change between the past, like early 2000s, where the 7.5s, to today? Is there a real difference? How did you guys buy then? What are you guys doing today? Chanel, we haven't started with you yet. Let's start with you.
Yeah, I mean, when I first started buying properties, I was getting loans from other real estate investors. And the loan rates are the same today as they were almost 20 years ago. The loan rates for hard money lenders are the same today as they were almost 20 years ago. So, and then for the bank, rates, I mean, we have, this is kind of a funny thing to admit here, but a lot of the houses that we still own that we bought over 20 years ago, we're just cruising down that amortization cycle. We haven't even gone back to refinance them, even though they are at a high 7.5% interest rate. The reason why we haven't gone back to refinance them is because we're in a location, most of our rental properties, for example, where the property values have doubled, and the rents don't keep up, at least where I'm at. So there's not an opportunity to hit those debt service coverage ratios that a lot of banks want, and when it comes to a refinance of a big portfolio of properties. So for me, when I look at what I'm paying as a percentage of interest versus as a percentage of principal, now that I'm 20 years into the amortization curve, it's like my effective interest rate is like 2%. Just because I'm already at the end, right? And what I love, of course, I love that quote from Einstein. The most powerful force in the universe, compound interest, right? For us, that looks like appreciation. And then Charlie Munger, who's Warren Buffett's right-hand man, he says it's compound interest, right? And don't interrupt it unnecessarily. How do we interrupt that unnecessarily? We are constantly selling, right? And paying taxes on those sales. We're constantly refinancing and paying all of the fees on the refinance, or we're setting ourselves up in a kind of a scary way by leveraging, a big portfolio just to get a little bit of a refinance out. So, to me, it feels like, again, it's still winning, just because, again, I have that 20-year perspective. But, I do want to kind of challenge all of us to kind of think like the new investor. And I think what's happening with the new investor is someone has kind of put this interest rate thing in front, let's say this is an interest rate, has put it in front of their face, and it's like, it's almost all that they can see. Versus us, we see this, we have all this perspective, right? And we can see way past this one thing that is an interest rate. And I think that's what, I think that's kind of what, Rob's saying, as well, is basically don't just focus on, what that interest rate is. And Alex, you've said it, multiple times too. Don't look at just what it, costs you, look at what it makes you. Have that understanding of what that opportunity is over the time that you're going to hold that asset. And then then don't be so swayed by the the news, right? So, I mean, I think that they are trying to sell ads, right? And rising interest rates and housing, man, that's going to sell a lot of ads, right? It's going to get a lot of eyes on them. But when we look at it as real estate investors, we don't see it in the same, in the same way.
No, I mean, absolutely. They're like we were talking about this in before. Hang out with people that are investing. Talk to people that are investing. If you guys are watching and networking, talk to those people, see what they're doing. One of the things that you'll always do is nothing beats fear on TV. So you'll see California start crumbling, and New York and Arizona and Nevada. Oh, the real estate market's crumbling. Is Dallas? Is Houston? Is San Antonio? Is Austin? Corpus Christi? Probably not. Pay attention to people that are investing in your area and see what they're doing, so you can be astute on what you're trying to do in your market. So great. So Kristen, what about you? I mean, I don't know if you were buying notes in the early 2000s or not, but what are you seeing if you're a deploying capital, you're buying notes, at par or premium or below? What are you seeing as the rates change? What do they need to do?
Well, so I'm a slightly different animal
Mhm.
because I'm buying 30-year fixed notes. So I'm going to trend more along what the bond market's going to do. If I get in because sometimes, depending on how big a portfolio is that I'm going after, it's 30 or 60 days.
Mhm.
And at the end of that 30 or 60 days, I mean, I've actually seen in the last 60 days offers going down. And you hear all about, how the yield curve inverted, right? And what does that mean? Well, it means that, short-term money is a lot more valuable, right? And so, yeah, I'm not surprised that hard money lenders or private lenders have altered. Again, it's something to watch, and it's something to make sure that you are setting up your owner finance notes correctly. Because if you can, instead of charging 9% interest, and you should be charging closer to 11% interest on an owner finance deal when you originate. Well, that's today, and this has changed. It's gone up basically 2 points in the last 2-3 months. So what are we going to be seeing down the road? And none of us has a crystal ball. So I would just encourage people to adjust accordingly for what they're seeing going on. Do I think we're headed for a huge crash? No. That's ridiculous. Have I personally ever turned down 12% money? No. If I need to get a deal done and somebody goes, yeah, I'll do it, but at 12%, okay, I know I'm only going to have that, 1 or 2 months.
Mhm.
So that means I'm paying 1 or 2% total to get that deal done. And, because you got 12% annualized and you're only paying, 1% a month. So I might only have that money, that short-term money out, 60 days, 90 days.
Mhm.
And then I'm going to refinance. And yeah, I mean, I've got loans now that I wrapped that are I think the highest one I have is maybe 7.25, 7.5.
Mhm.
Do I feel the need have I felt the need over the last 10, 15 years to ever get rid of that? No, I'm like, no, they're fine. I'm still as long as I'm still cash flowing and I set those up accordingly. It's just maybe that rainy day X factor. If you all of a sudden decide, hey, I need to sell these for whatever reason, there's divorces that happen, people get sick, there's health funds, you want to pay for your kids' college, you want to go do something different, you want to go invest in multifamily, so you've got these notes and you want to sell out and get, as much equity you can for them. Make sure they're set up right and make sure and adjust, just say, okay, I can still borrow at 10. That means, I should keep originating at, 9 or 10% as well. I would say it doesn't work that way.
And I mean, every problem has a price, right? Every problem has a price. You just have to price it in. And
Yeah,
I think,
it's adjusting for market. And for what I'm seeing, are people still trying to get me to buy 6 and 7% paper? Yeah. And can I buy it? Yeah, but it's not going to be anywhere. I mean, I pride myself. I mean, I pay a heck of a lot more than everybody else out there, but even I can't work miracles.
Right.
but
when
you
interest
can make
rates
them
are
an
ticking up.
offer. You can make them an offer and just price in the fact that they
Oh, I do.
Yeah.
Right. Yeah. They're just surprised and they're like, oh, wow, I thought I did really well on this. No, sorry.
One of the things everybody saw today is somebody using functional math in real time to say, what is this making me? What can I buy this for? What's my spread? Again, I cannot stress enough that investment real estate is math. And if you're in the black in the property and that black number equates to your business plan growing, you buy the property. Basically that. So Rob, what are you seeing? It's kind of the same thing. Like, we started because you were talking about this, back in the early 2000s, 7.5. We may be approaching that again. What are some insights that you did that gained success that you can tell everybody? Don't be so weary. It's okay.
I think for the last several years, we have gotten so hooked on this really cheap money that was out there that almost any deal would work financially because the cost of capital was so cheap. Now you have to actually evaluate the deal a lot more on its merits. You had a lot of people who have been overpaying, I think, for properties for the last several years because they wanted to get it and they were hoping there'd be some continued appreciation. Texas is not known for appreciation much more than 6% a year. It's this last couple of years, it's been out of control, which has been great. If you're selling, not so much if you're buying, but I think people need to get back to the fundamentals. I've always been teaching and preaching that if you're going to buy real estate investment property, you should be buying it where the purchase price and cost of repairs doesn't exceed 70 or 75%, period, end of story. You can stretch on a higher valued property because there's a lot more margin of error. But if you're on an entry level property, first time home buyer type property, and you're stretching beyond 75%, you're setting yourself up for disaster because there are always things within the process, whether it's, again, not right now, but as the market begins to return to more normal type of matrices, you're going to have things that happen such as longer hold times than you were expected. You're going to see people finding things in their inspection report and really pushing back on the purchase price. You're going to find issues during your rehab that you didn't anticipate that are going to blow your budget. And so if you build in a certain amount of hedge, which is typically that 20 to 25 to 30%, then you've got the ability to always make money on the property. It goes back to, again, what we all said was you make money on the buy, not on the sell. You've got to factor in the fact that you're going to have these things happen. And I think that's the thing that people need to get back to. These real estate investment shows have been great for some of our businesses and absolutely horrible when it comes to managing people's expectations. And people always think, like, oh, I can do this in 30 minutes and make tens of thousands of dollars. And it's obviously, as we all know, it's not even close to that. And they never show all the challenges and the things that go into making a successful flip. That's what I think we need to help educate people on and back to the basics, which are, hey, you make money when you buy, not when you sell. Build in enough equity into your property, including rentals. I've always advocated that if you're going to buy a rental, you buy it as a fix and hold, not a buy and hold. Because if you're buying a fix and hold and you're buying at the 70%, 75% rule of thumb, you're going to have enough equity that if the market ever does shift dramatically and you go to sell it, you'll have the equity to take a bit of a haircut without losing your hair.
Right. I mean, so think about like, you know, he mentioned a couple points. Again, back to math. You look at these DIY shows. This is a group in California. They bought something for 600. They put 200 into it. They're in it for 800. They sold it for $9. They made $100,000. No, they didn't. They didn't calculate their holding costs. They didn't calculate their electricity bills. They didn't calculate their permit costs. They didn't calculate all these
TV profit, TV profit.
TV profit.
Yes.
So that's why, again, just understanding the basics of math. A great another, again, summary that 70 to 75% minus repairs at closing usually should be a good rule of thumb for a good purchase price for that equity spread that you need to keep staying in business. There's always a contingency. There's always something going on. Rate never costs you a deal. Points never cost you a deal. It's the cost of doing business and the speed of the transaction. So,
And if those things, I don't mean to interrupt, Alex, but if those things are costing you a deal, you bought the deal way too thin.
correct. So if you ever say, I never want to hear any of you say this, man, if this happens, I'll be okay. No. Okay. Oh, if I could have got my rate down, I could have done the deal. That doesn't make sense. There's one variable that you can change, and that's purchase price. And a lot of you are saying, well, how can I negotiate in this market? That's when you start getting into calling Rob, calling Shanoa, talking to Kristen. How do you do this? How do you negotiate? Maybe start picking up some books on how to interact with people. But these are all great points. And as you notice a trend, we talk about interest rates, but not one person has told you not to buy anything. Everybody's telling like, I don't know what you're talking about. I'm just going to keep buying. So really great stuff so far.
Alex,
So-
I have a question, if you don't mind. And I asked you this at the Think Realty Expo. And I think we've established that interest rates, they can go up and we'll all still be okay. But I asked you, and I'd love to know the perspective of Rob and Kristen too. Asked you the question, what keeps you up at night? Right? What is the thing that's going to come up and punch us in the face that maybe we're not planning for, right? Since 2008, kind of surprised me, right? I was able to survive and thrive, but I mean, that kind of punched me in the face, right?
I love that you say survive and thrive. I still have PTSD from 2008. I really do. I mean, my gosh, I looked great on paper. And then all of a sudden, July 2008 hit, and overnight, I was like in the red and I was toxic to lend money to. But man, what keeps you up at night? I'm sleeping well now. Alex? I mean, I didn't see 08 coming to Texas. And in fact, in 07, I was asked about it. July of 07, somebody said, hey, you're seeing all of these foreclosures, right? In California and New York. And I said, it will never happen in Texas, never. And I'm going, we've got too many corporations moving here. We've got, too many people moving here. We've got like 100,000 people moving here a month. It will never happen. And
But did it? But actually, it really didn't, because it wasn't a problem with huge foreclosures here, although there were a lot. The problem was the fact that there was no capital to buy those.
There was no
properties.
capital to lend.
Right.
Yeah, it was an absence
wasn't
of
like
capital.
the values dropped overnight. It's the fact that we couldn't get any of these deals that were still solid deals financed.
Right. Well, so we did have massive foreclosures then.
Well, right. But I mean, it was
But-
foreclosures not because of being underwater in their property. It was because they couldn't keep paying the debt, and they had some horrible loans, but it wasn't that there was tons of buyers, just no one could get financed.
Yeah, the banks stopped doing their jobs.
the subprime faucet turned off, and that was how a lot of people were doing their deals. And
Yep.
Well, I hear the subprime faucet has been turned back on.
well, it's interesting that you say that, because what it looks to me, and again, I'm not in a hedge fund or anything like that, but if anybody on this panel and people listening and watching, you haven't noticed, there's a huge talk about what's called non-QM loans, non-qualified
Ninja.
loans. Yes.
Yep.
So what that is a way for you as an investor to buy some are personal, but most of them are in business names, to buy an asset where the asset backs up the property. And they use something which was said earlier called a DSCR, debt service coverage ratio. All that means is if you have a 1.2% DSCR, if you have a property where it's mortgage, principal, interest, taxes, insurance, and any HOA fees, it's $1,000. Your property has to rent or could be rented for $1,200, a 1.2 ratio to say that this property is supporting itself while occupied. You can do as many as you want. And if you haven't noticed, places like Blackstone and Invested Homes and all these other places are have a large appetite for now single family homes, where they used to be one of the largest purchasers of commercial assets. So the subprime money went back into properties in a different way, in my opinion.
Well, you know, it's interesting. If you guys remember when COVID first hit 2 years ago, everybody was running around saying, you know, the sky is falling for the real estate market, that everything, and those same non-QM lenders basically hit the pause button.
Yep.
Especially for funding fix and flips and buy and holds. And I remember I was getting inundated with people that had put these loans on their warehouse line, and they couldn't unload them. The warehouses were calling their notes, and they were trying to unload the properties. The thing that I worry about with some of these Wall Street backed, you know, money machines is that their level of due diligence, I don't think, is as solid as it should be. Because I looked at a lot of those portfolios to see if I could fund anybody, and I couldn't rationalize A, the appraised value, or B, the cost of repairs. And I wasn't planning to buy a portfolio that I couldn't look and go, well, that's not going to turn around and bite me in the rear end. And that's what I worry about from that side. Wall Street is oftentimes loose with the fundamentals. And if there's anything that's going to sort of recreate that challenge of 06 and 07 and 08, it's going to be those non-QM lenders that are, because Wall Street
I hear they're back. And when so I was a recipient of a lot of those. I'd like 20 some on my own personal credit, just me. And this is like, you know, early mid 2000s. And I was not allowed to put a number on the application. I kid you not a social security number, not a birth date. This is back when they were giving loans to dogs. Remember that? They were like, can I get my dog a home loan? And they actually proved that they could. I mean, it was staggering. I haven't really needed to or want to go and, you know, try to get one of those again. But I'm hearing like little rumors here and so-and-so, they're doing ninja loans. And I think if it continues like this and people, you know, if they really keep those, you know, the regulations loose on it, yeah, I think they'll start writing them.
Well, have you guys worried about like all these hedge funds who just like, well, yeah, I'm out of the real estate business, so let's dump 10,000 properties on the market today?
You mean like Zillow?
Well, I mean, I don't think they're dumping 10,000, but I mean, like, I don't think they had that many, but some of these other larger hedge funds, I think they have the ability to add supply like that. I've been worrying about that for quite a while, although, you know, they've seen their, you know, values go up, right? So they're making money. But
Could they decide to sell out? I think yes, obviously they could. I would hope that they would be a little strategic about how they do that.
Well, they basically gave their money to teenagers at auctions and just said, go buy whatever's for sale. And we don't really care if you bought it right or not. And they ended up winning because the market, you know, started to go like this. And I thought they were going to get themselves into a lot of trouble until, you know, we stopped building houses and more people started to move here. But at some point, I feel like they're going to want to take their winnings. And the way that they're going to take their winnings is to dump some of these properties that they've been buying over the last, you know, well, since roughly 2008, 2010.
Mm-hmm.
Yeah, that's a good question. I'm a little more worried about the people that are now doing all these build to rent neighborhoods. I think it's a neat idea, you know, basically have condo type of care for your lawns and everything. But what happens when they decide? I was talking to someone that said you need to have almost 225, I think was the number he said, units under management in order to make money on a neighborhood. So if they're building a neighborhood of 225 rentals, if they're, as long as they're managing the property, great, the properties are going to look good. But we have all know what renters do to our properties. And we all know as we drive through a neighborhood, which houses are rentals because they're not maintained. And if those people sell the assets in those giant communities, how are we going to put owner occupants in a primarily rental neighborhood? You're not. And
You're
so
not.
you're going to have I think you're going to have a 225 unit mess.
Yeah, that kind of reminds me of It's a Wonderful Life, which is my husband's favorite movie. And they kind of painted these two pictures, Pottersville, which is a community of just rental properties, and then George's, the other bankers, community, which is of proud homeowners, right? So that is interesting. That is interesting.
I mean, if they did something like that, it's one of those things where it would shake on what could happen. I mean, you flood the market in with those kind of homes, who knows? But those are kind of things that could keep any investor up at night. So as we're winding down, we got about 10 more minutes. Let's check with Rodney. Let's see if anybody had any questions. I'd be very surprised, guys. You have a panel in front of you that could probably answer, how to hang the moon. And if you don't have, if you don't touch them right now, you're missing out. Don't worry about if the question sounds silly. There's no silly questions. The four of us always remember the time we didn't know. Never forget the time you didn't know. Always ask the question, always gain knowledge. Let's see if we have anything from Rodney on any kind of questions, just so we make sure we get anything going on. Rodney, we got anything kind of questions? I'm looking over here. So far, I don't see any. If I keep talking for the next 10 minutes.
Alex, I think we've solved all the problems in the investing universe. So let's call it a day, my friend.
All right. So now that you guys know everything, you can just go out and make millions and millions of dollars. Okay.
Well, the moral of this whole thing that all of us have said, don't worry about the interest rate, because it's going to go higher. Yep. You're not going to stop investing. And stop kicking tires. Stop, we've got a lot of analysis paralysis out there, especially, I'm sure Shanoa sees it in her group. She's got all these brand new investors and she's just trying to get them off the fence. And then what happens? Interest rates go up 2%. People are like, whoa, I can't do that. No, again, one of my first loans I got was like 9 something, and it was adjustable rate. It adjusted every single month. Oh. And I think at one point it hit something like 12%, and I hated this loan. But it was like, 700 or 800 of it paid down principal every month. So it ended up being pretty cool, when I had it, 2 or 3 years down the road. But again, look at what you're buying, and try to get locked in for as long as you possibly can at 6 and 7%, right. Because I honestly think it's going to be low.
21 years ago, bit of history. Our typical loan program 21 years ago was 5% origination, 14% interest. 5 and 14.
Which is usurious in the state of Texas, but
yeah,
usury is 18%.
Yeah,
but anyways,
right. But yeah, well, it also real estate sometimes pulls 21 as the usurious number, but neither here nor there. But yeah, that's what rates were back then, and you're not going to see that, I don't think, for a while, just because of the amount of capital that's out there. So it doesn't matter if interest rates go up to 7 or 8%. I don't see my being able to raise rates significantly because there's too much cheaper capital out there that we have to stay competitive. So I don't think any of us are talking. In fact, I know unequivocally none of us have talked about rate today, other than to tell you don't talk about rate because it's irrelevant.
Mm-hmm.
It really is. And especially for short term, if you're talking about short term capital, it's cost of doing business. Figure it into your calculations and pay it. And I think Shanoa has had some really good advice. Buy what you can. And even though I've recently sold a couple things, I'm buying right now. And I buy notes every day. I'm always buying notes. But as far as real property, yeah, I'm buying as soon as I possibly can, every chance I get.
Yeah, definitely. You guys should be out there buying properties. A lot of you are like, well, I can't, I mean, they're just going so fast. Follow up. There's plenty of properties I know that sold and they are still there. You know, especially the distressed. Remember the distressed market's only about 2 to 3% of the real estate population, and that distressed market usually doesn't shift much, no matter what the market is. People get divorced, people have passed away, people are moving to Georgia, whatever it is. There's always about 2 to 3% that's distressed. That is what we help manage, buy, invest in, and try to make our return. So stick
Try to
with
be
it.
where someone isn't.
Yeah.
I mean, you're absolutely right, Alex. Try to be where everybody else isn't. And that way to find ways to take a property and add square footage to it in order to get the difference between the sales price per square foot and the remodel and build price per square foot. There's a lot of different ways that you can still find viable deals. It just takes a little more creativity.
I couldn't agree more. All right. So, you know, what do you have to add? What kind of last words of wisdom could you impart to the people that are listening to say, not only go out and buy, but how to formulate a team, how to get the knowledge, with the three of you, how can they do that? How can these people do it? They're still unsure. What could they be sure about? What could you tell them?
Yeah, I mean, get started. For us, as Kristen said, we help a lot of new real estate investors as they're getting going. When I first started almost 2 decades ago, I joined my local real estate investor association. It was there that I got my first deal. It was there that I got funding for my first deal. And it was there that I got all my tribal knowledge. I got my last deal also at the Real Estate Investor Association, right? I'm always surrounding myself with other investors, and I'm always also taking part of these, opportunities as well to speak to new investors and to hang out with other investors that have been doing it for a long time that can share and impart their wisdom and what they're seeing in the street. For me, I'm always learning, and I feel like every day as a real estate investor, I get to learn something new. And that curiosity, right, opens me up to all the different things that are coming in the environment right now, that are coming in both to lift us as well as maybe to kind of pull us down a little bit. And I love spending time on these exact opportunities, just talking about where the market is going and listen to what other really smart, creative real estate investors have been doing to survive and thrive through the different cycles and what they expect to see coming, right? You should be well networked. I think that is a big part of learning, growing, and being successful.
Well, fantastic. Well, guess what? We have a question. All right. So Rick says, Kristen, I know you don't like talking specifics, but on owner finance, how should an investor structure the note for you to buy, i.e. percentage of note value, what interest rate for the discount rate, seasoning, etc.? I know many investors interested in creating and selling notes, but I just need to know the basics. How does he do that?
Okay. So I do have a whole thing. I did a whole video about this, something like huge profits with owner financing or something. It's on that. Send me a link and I'll send you that thing. And it goes into detail how to do this in a nutshell. I like the 80-10-10 version. So if you only get 10% in your down payment, you want to set up an 80% first, even if it's wrapping around debt or whatever. Forget about that part, but the 80% first, then you're gonna have a 10% second. So that if you decide you want to sell that 80% off and pay off all of your acquisition and your rehab costs for that, leaving you with just your 10% down payment and your 10% second lien for long-term wealth building. So you'll keep that, that second lien, and you'll just keep the cash flow from it, which, yes, it's not very much when you first look at it, but I'm a big believer in, getting as many owner finance notes as you can that are completely debt-free and selling off your wraps, especially if you pick them up subject to, because you can run into a lot of nightmare scenarios with that. So having that where, it's completely debt-free and you're getting in like $200 a month is great. And especially if you just lather, rinse, repeat, and you're able to, get up to doing 1 or even 2 a month, it's pretty easy, but it's making sure that when you buy it and that you're selling it right and making sure that you know exactly what that after repair value is, because any note buyer is going to run comps, or in my case, I order BPOs, broker price opinions, on every single one of the notes I buy. Unless I get an appraisal that was done at time of owner finance sale, which is not required to do, but man, it helps a lot when I'm trying to buy a note. So hope that, I can read this. Do many wrap hard money or private money loans and then cash out the lender in 6 or so months? So I'm sure Rob, Barney, and Alex are both cringing at this of what I'm going to say. You should never legally wrap hard money. Can you do it? Yes. If you already have that set up as an exit strategy and you do it correctly, your title company will make the borrower sign a disclosure saying, hey, this is wrapped with money that is going to be called due in a year. I would highly suggest that you have that negotiated and let your private money lender know what you're doing. I can tell you, when I was doing hard money over at Bay Mountain Capital, we very much frowned upon that because hard money lenders are regulated by the SEC and cannot legally give a loan to something that has an owner occupant in it. And so that's a lot of where you run into that problem. So be very careful doing that. Make sure, your borrower signs all the disclosures and that they know what's going on, and make sure that you have that exit strategy there. There are other things that can go wrong there. So
You're absolutely right on that.
We won't do it.
Nope.
no, I know.
And
And that's kind of the answer. And of course I get a call every now and then going, hey, my borrower decided to wrap my hard money loan. Can you look at it? Always. So, and hopefully it was set up correctly.
that's actually, I can't speak for Alex, but for us, that's an instant default that we have to call.
Right. Due on sale.
Correct. Which is why I always get like the call, the week before it's going. The week before it's going to auction. And then I'm like, okay, let me step in, see what I can do if I get this thing closed in a couple days.
Well, we're just about out of time. Let's go to Rob. Tell everybody again, about just a recap who you are. How do they contact you if you said anything of interest that they'd like to say hi?
Absolutely. Again, I'm Rob with DHLC. We're a private money lender out of Dallas, Texas. We lend all across Texas. You can reach us at our website, which is simply dhlc.com, Delta Hotel Lima Charlie.com. Been great talking with all of y'all. And one of the things I would suggest all of you look at is literally everybody here at this group has been doing this for 10, 15 years, 20 years. There's a reason why, because it's been an amazing industry for us. Go to the people that have been here for a while. These are the ones that are going to always shoot straight to you.
What about you, Shanoa? How do they contact you?
Yeah, Shanoa Grove, Texas REIAs, Texas REIAS stands for Real Estate Investor Associations. Love to have you join in on one of our live meetings in Austin, Houston, Dallas, or San Antonio. We are Texans teaching Texans how to invest in Texas using strategies that actually work in Texas. So stop going to the traveling road shows and go to people who are local and know the rules where you invest, know the laws where you invest, and know the customs, have the contacts, have the tribe, and all the tribal knowledge.
What about you, Kristen? How would they contact you if they needed your help?
You can get a hold of me. But easiest way is probably email info@capricornmortgage.com. I do believe my cell phone number is probably all over the internet. So if you type in Kristen Gerst, you could probably find it. Send me a text. If I don't respond right away, don't leave me a voicemail. You're not going to hear from me. So.
And to kind of sign it off, I'm Alex with Jet Lending. You can go to www. I always say www like nobody knows, but www.jetlending.com. You can call or text 281-872-7800. You go to our website and get pre-approved to get your deals done, evaluated, no charge, tell you what's going on in the market within the first 24 hours. again, guys, everything I think was fantastic. If you don't reach out to one of these people later on today, I think you're missing the boat. I think you guys going to see that interest rate's not going to slow you down very much. Rob, Shanoa, Kristen, I think it's been great. Everybody, I hope you enjoyed it yourself and learned a lot, and we'll see you next time.
Thanks, Alex.
No problem.
Bye, everybody. Have a great day.